hysterically speculative investor behavior. I believe this event will be recorded as one of the great bubbles of financial history, right along with the South Sea bubble 1929 and 2000. But this last bit that he said is probably the most important for all of us investors. He continued that these great bubbles are where fortunes are made and lost, making it a fully fledged epic bubble, featuring extreme overvaluation, explosive price increases, frenzied issuance, and make no mistake, for the majority of investors today, this could very well be the most important event of your investing lives. End quote. So what's going on in the market today and how we choose to deal with it could determine how rich or how 10-year treasury bond that's sitting at basically the lowest it's ever been in history. It's currently at 1.2% right now, meaning if you bought a 10-year treasury bond, you could expect a 1.2% return every year. Inflation, at the very least, will be around 2 to 3%, meaning every year your real returns will be in the negative. As Jim Grant said, it's the most overpriced that it's ever been in 4,000 years. But the main asset class that Grantham is warning about is the stock market. If we take a look at the S&P 500, which is the general indicator used to measure the USA market as a whole, or how poor we are in the future. Now, speaking about the way we invest in the market today, I want to thank the sponsor of today's video, Titan. Titan is an actively managed investment firm that focuses on long-term financial growth. If we take a look at Titan's flagship portfolio return since inception, it's been 22.1%. That's higher than the S&P 500 and higher than all major indices and robo-advisors. Over time, this higher return can make a huge difference in our net worth. So what they've done is they've built a mobile app instead of a mutual fund. This way you can see exactly what's happening and how they're managing your money. As well as their equity strategies, they also have an actively managed crypto option as well. I like the fact that you get direct exposure to their investment manager through content like Instagram stories, and they have no performance fees, no lockups, and a low flat rate advisory fee. You can get started today at titan.com/Cooper and get your first 3 months of expert investment management for 0 fees. 30,000 clients and counting.
And this time, we're really playing with fire because this time, unlike 2000, we have an overpriced bond market. Jim Grant would argue the most overpriced in 4,000 years.
Right.
We have, in my opinion, and that of many other bubble students, the most overpriced US equity market in history. We have a housing market that 3 weeks ago reached the same multiple of median family income as it did in 2006 at the peak of the...
This is sitting at 4,400 points. That's more than 2.5 times bigger than what it was in the height of the Great Financial Crisis, as well as the 2000 technology bubble. In just 12 years, what has happened to the market, very few could have predicted. As Grantham's GMO investment firm said, it gives us no pleasure to remind our clients that US stock valuations, by almost any backward or forward-looking measure that we've come up with, are at levels that concern us. Bubbles are unbelievably easy to see. It's knowing when the bust will come that is trickier. You see it when the markets are on the front pages instead of the financial pages, when the news is full of stories of people getting cheated, when new coins are being created every month. That's what's going on now. The scale of these things is so much bigger than in 1929 or in 2000. End quote.
In 1929, the market didn't peak when they thought the underpinnings were terrible. They peaked when the market's enthusiasm for the underpinnings was approximately the highest it had ever been in history. In 2000, in March, the world uniformly, including the boss of the Federal Reserve, Alvin Greenspan, they all thought the system had never been better. At the top of the housing bubble in 2007, Bernanke and the boys thought the US housing market had never declined, unquote. It merely reflected a strong US economy. The underpinnings were great. They have never gotten it right. The Federal Reserve in particular has never had a clue about asset bubble. It doesn't even address it. They act as if they don't exist.
You see, if you look back through history, at every time that we know the market has peaked, there was strong enthusiasm throughout the market. In 1929, at the peak, it's not like most people were pessimistic. No, everyone thought the market was great. It was a money-making machine. The Ford Model Ts were selling. The newly invented vacuum cleaners were flying off the shelves. Many things looked great, and most people were optimistic. But then there was a great swing of things and everything crashed, as we know. In 2000, things looked great as well. The internet was new and people saw that it would change the world. He went on to say that there will be an enormous negative wealth effect, broader than it has ever been, compared to any other previous bubble breaking. It's the first time we have bubbled in so many different areas: interest rates, stocks, housing, non-energy commodities. On the way up, it gave us all a positive wealth effect, and on the way down, it will retract painfully. So it's pretty fair to say that Grantham is not a fan of the prices in today's market at all. He said 3 key asset classes are overvalued: bonds, stocks, house prices, and even some commodities are looking expensive. But I want to know what you guys think. Is Grantham correct in calling this a major bubble, or are you more inclined to agree with Cathie Wood, who argues only certain areas of the market are showing bubble tendencies? Either way, when you look at the facts that Grantham provides, it's quite hard to disagree with him. And they thought they could make a lot of money through this in the stock market. Optimism was high, but it was too high and prices had gone up too much, and we saw the great technology market crash. It's the same story with 2008, where the chair of the Federal Reserve, Ben Bernanke, said the US housing market had never declined and was unlikely to. But we all know what happened. And guess what? Grantham thinks a similar pattern has formed today in 2021, and when I say similar, I mean similar but on a bigger scale. People are optimistic. Technology, AI, electric vehicles, stock prices are at highs we have never seen before, but optimism is often a precursor to a great crash. It's normally the people on the edges, on the fringes of the investing world, who predict the crashes. The likes of Michael Burry, who wasn't afraid to think differently from his clients. Or Jeremy Grantham, who was paid for finding value investments, not paid for finding the next great growth stock. In fact, I hope it does, because it will give us the opportunity to warn more people. The probabilities are that it will go into the fall. The stimulus, the economic recovery, and vaxxers have all allowed this thing to go on a few more months longer than I would have initially guessed. What pricks the bubble could be a V-word/illness problem, it could be an inflation problem, or it could be the most important category of all, which is everything else that is unexpected. One of 20 different things that you haven't even thought of will come out of the woodwork, and you had no idea it was even there. Jeremy Grantham is a very well-known British investor, and in particular he's well known for his market forecasts. He predicted the burst of the 1989 Japanese asset price bubble, he predicted the technology bubble in late 1997, and he even warned of the developing subprime mortgage and credit bubble in the late 2000s. So he's got a pretty good track record. Now, the interesting thing about all of this is he's made another big call on the stock market in 2021. He said that the market has formed into a bubble of epic proportions. Here's his exact words. He wrote an essay for his investing firm GMO titled "Waiting for the Last Dance: The Hazards of Asset Allocation in a Late Stage Major Bubble." He wrote, "The long bull market since 2009 has finally matured